All right, so Section 1033 deals with involuntary conversions. And here's really the idea. We've got some events, and when you have certain events, you should always think about involuntary conversions. The events specifically, we're talking about events like natural disasters. So think about different types of natural disasters, right? You got hurricanes, tornadoes, tsunamis, floods, hail. You can also have shipwreck, theft. Again, the idea here is involuntary conversion. So natural disasters, theft, shipwreck. Also included in involuntary conversions are going to be state and local government activities, specifically of property, your property. Some specific ones include eminent domain, condemnation or seizure, right? So the main example here that many of you probably know about is, let's say the city, state wants to come and take your property, to build a highway or an arena like they did in Miami. Okay, take part of Miami and build the Marlins Stadium. The city or state will then pay you proceeds for just compensation for the value of your house. Or for the natural disasters or theft, you might have your property insured. And the question is, if you receive insurance as a result of this hurricane comes, completely destroys my house. I'm not going to put that on anyone else. Destroys my house. Okay, destroys it. Let's say that I bought it 10 years ago for $120,000 and I get $200,000 because the value obviously increased. $200,000 from my insurance company for the house. Well, think about property transactions. We've been talking about realized gain or loss. You've got your amount realized, which is going to be the amount you received from the insurance company, right? $200,000 minus your adjusted basis. And let's assume that I have not added anything to the house or like a pool or any new rooms. And of course, it's personal use property, so I can't depreciate it. So the adjusted basis is going to remain the cost, $120,000. So I've got a $200,000 amount realized. Oops. Get ahead of myself there. $200,000 amount realized minus adjusted basis of $120,000. I've got an $80,000 realized gain. So you're telling me I'm going to pay tax even though I didn't actually want for this event to occur? Well, Congress sides with me. And there's a special rule, a non-recognition rule, right? We've got our non-recognition rules we've been talking about, like-kind exchanges, that apply specifically to these events, gains. Only gains. And you have to elect. Elect means that it's not required, it's may language, right? Like-kind exchange, section 1031, is shall language, which is mandatory. If you meet the criteria, you cannot recognize. For this one, if you have a gain, a realized gain, and you don't want to recognize, which most people don't, right? Unless you have some type of NOL or something that's going to be expiring soon, or tax rates might change. You generally don't want to recognize your gain this year. You want to push it as far into the future as possible. Time value of money. So this is going to be, section 1033 is going to be a discretionary provision. You can elect. You have to elect. It is elective. But it only applies to gains, not losses. You have a loss in this event, you got to take the loss. Okay. Now, of course, I'm getting cash. And we know non-recognition rules. If you get cash, you can't get non-recognition. We know that's one of our common themes. So I get $200,000 of cash from the insurance company. We know if you get cash, gotta recognize, because the liquidity concern is not an issue. So stay with me. We've got these events, right? Natural disasters, theft, shipwreck, state and local government activities like eminent domain, seizure, condemnation. We're going to add some propositions on there to get non-recognition. We know, and here they are. We know it has to be property. We've been doing property already. Must be compulsorily or involuntarily converted. So that gets to our events that I've mentioned already. So we're already, hey, we got that, right? Hurricane destroyed my house. I got $200,000. It was property. Into money. Hey, I got $200,000 from the insurance company. And the taxpayer, during the specified or period specified, purchases replacement property. Well, if my house gets destroyed completely, I've got to find somewhere else to live, right? I could rent. I could stay in a hotel, right? Maybe the insurance company reimburses me to stay in a hotel, me and my family. Another option is I go buy a new house. So during the period specified, we're going to talk about that in a moment, I'm going to have to purchase replacement property, and the replacement property must be similar or related in service or use to the property that was involuntarily converted. So if it's a personal residence, I go out and I get another personal residence. I can't do a personal residence and then acquire, let's say, an office building for my business. Okay, so let's move on. We've gone through those propositions. Let's go in a little bit more depth. So what exactly is an involuntary conversion? Well, as it suggests, it's involuntary or involuntary. Involuntarily, it happens, right? It's different from a sale or exchange, which are both considered voluntary transactions. We've talked about those before with the like-kind exchange topic. Involuntary conversion, again, we're talking about natural disasters, theft, shipwreck, right? Fire, eminent domain, seizure, requisition, imminence thereof. Now, going back to our propositions, there was two major things that I kind of said that we're going to talk more about because they're probably the most contested, I would say, of the propositions. The first one is the replacement period. What exactly is the replacement period specified by statute? The general rule, and if you're taking my class, this is the one I want you to learn, is 2 years. You've got 2 years. However, in some special cases, like a lot of the presidentially declared disasters, like Hurricane Michael, Hurricane Katrina, Hurricane Andrew, you might get 3 years. There's actually some cases you might get 4 years as well. I know of one example deals with the farming industry. Certain farming issues like crop. This involuntary conversion goes way more than just my personal house. It also applies to what happens if your crops are destroyed involuntarily, stuff like that. Okay? Again, it only applies to gains though. But 2 years, that's the main rule. Taking someone else, another class, they might require you learn those other ones. CPA exam, they really focus on 2 years as well. The main thing that's litigated, I shouldn't say always litigated, is what is similar in service or use property. I used to talk about this one in much more depth, but I've kind of learned, for the CPA exam, my exams, even other professors, unless you're taking a law school exam, this isn't really something that gets tested too frequently. But in practice, you better believe it's a difficult issue. You could probably think of so many examples. You could stop the video right now and just say, okay, well, what if, my office building is destroyed by a hurricane, completely leveled. And I go out and I buy another office building and I only use some of the money, or I get another office building, but it's so materially different. Maybe it also has sleeping quarters in it or something like that. Or usually where I see this issue come up is more personal property rather than real property. Like maybe you have, you've got a semi-truck and you acquire maybe like an F-150. Well, in the tax law, there's differences when it comes to the weight classes of trucks, just like with depreciation. So this similar in service or use property, for my classes, my exams, it's very clear, right? If you have office building to office building, you're using real property for the same purposes before and after, that qualifies. Real property is a lot safer to view. If you have an office building destroyed and you acquire another office building and you acquire equipment, the equipment's not going to qualify as similar in service or use property. The other office building would, even if it's smaller. But the equipment you buy with the money from the office building being destroyed, that's never going to qualify. Never. Real property for personal? No, not going to qualify. Okay? So just keep that in mind. If you want more information, there's a revenue ruling, Rev ruling 64-237. You can read that. You can pause the video. You can Google it. You can look at that if you want. But again, it'll be pretty clear in my class, my examples. And we're going to look at some examples in a later video that actually go through and you see how there's similar in service or use property and also some non-similar in service or use property. All right, so there's two more issues that we have to address when it comes to involuntary conversion. Every non-recognition rule has a corresponding basis rule. Right? Non-recognition, again, as you know, is deferral. It's not an exclusion of gain or loss. It's a deferral. By the way, some of you out there might be watching this video. Maybe you're already a tax expert. If you're watching my video, not sure why you're watching my video, other than maybe to brush up on your techniques, you might be wondering about my personal residence issue. Like, hey, couldn't you just exclude under Section 121 under the 250,000 or 500,000? Yeah, you could, but I'm just trying to show an example of, where this happens in everyday usage. Okay, so yeah, there might be some other exclusions because exclusions, as we know, are better than deferrals because exclusion's permanent, but that's a special rule for personal residences. Okay, so non-recognition rule, deferral. The deferral comes through the basis. So Section 1033 actually provides a basis rule that is the shortcut method. You might recall from my like-kind exchange video or that topic that there's a long basis calculation that comes from the tax law, Section 1031, that calculates the basis of the new property. And when I go through my like-kind exchange analysis, the videos, the topic, we always calculate the suspended gain or loss, and we can check our work. I told you in those videos that you could do the shortcut method, but you can't check your work. And the shortcut method doesn't always work, especially if you have multiple exchanges where you have like-kind and non-like-kind property for like-kind and non-like-kind property. It doesn't work. If you don't believe me, go try it. For 1033 involuntary conversions, the tax law actually says to use the shortcut method. The shortcut method, we're going to take the cost and we're going to subtract away the suspended gain. Now note, not suspended loss, suspended gain. Why? Well, if you don't know, you might want to pause the video and think about it. But the reason why is because 1033 only applies to gains. Involuntary conversion, non-recognition only applies to gains. If you have a loss, you can't get this rule. So it's going to be minus the suspended gain. You can't have plus the suspended loss. That is the shortcut method. So it's not the long formula like kind of exchanges where you take the old basis, you carry that over, plus any money paid, minus any money received, actual or constructive, plus any recognized gain, minus recognized loss, all that good stuff. No, you just take the cost of the new property at issue, you subtract away suspended gain, boom, you got your basis. But you can't check your work, unfortunately. You can't check your work. The good news about using this formula for my exam, CPA exam, is that like kind of exchanges, you better believe you're going to see lots of liabilities. This topic, not so much. This topic is more straightforward. Okay, so I want to talk about that. There's also a note here about allocating basis among pieces of property if you have more than one like similar in service or use piece of property. Of course, like normal, we always use the relative cost, relative fair market value, just like in accounting. And we'll talk more about that when we talk about purchase, sale, or business and the class system of allocation. The last thing I want to mention before we look at the checklist, and I always get this question, what if you use the money and buy similar in service property, and then you use some of the money to not buy similar in service property? So we're going to see an example of this, but you might recall from the like-kind exchange and pretty much every other non-recognition rule out there, right? Thinking with our general themes of liquidity and economics. If you have boots, which remember is basically non-qualifying property, the rule is going to be the lesser of the realized gain or the amount of boot. Now we're going to supplement boot here with the amount of insurance. So I do insurance in my example. Proceeds not used on qualifying property. So the lesser of the realized gain you calculate, or the amount of insurance proceeds not used on qualifying property. If you want to think of that as boot, whatever, that's fine. But if you don't want to do anything with the money, it's just going to be the difference between those two. I'm sorry, not difference, the lesser of those two. Okay? The checklist walks you through all the steps in an order that will help you. So first thing is, do we have an involuntary conversion? That's where we focus on the event. We've got some examples here: natural disaster, theft, seizure, requisition, boom. If we do, we continue. If not, can't get it. Next thing you need is a realized gain. So if you have a realized loss, can't get this. Move on. Third, conversion into cash. So are you getting money as a result of this transaction? Most common example is from insurance proceeds. If so, then the amount of the gain recognized, if any, depends on whether the taxpayer ultimately purchases property similar or related in service or use, and also within a specific period of time. Remember the 2 full taxable years, 2 years. And as I mentioned, there's the lesser of rule, right? If you use anything on non-qualifying, we just talked about that. If not, then it does not apply. This special rule does not apply. And then here's the basis. If you do have qualifying property, make sure you use that basis.